Good afternoon. Thank you for allowing me to present my research in this workshop. The usual disclaimer applies. And this is a theory paper about the liquidity regulation of credit lines. So first, let me briefly explain what a credit line is. In a credit line contract, firms can draw down funds at will up to a limit at predetermined terms. And these contracts are important for both banks and firms. And there is a key feature of this contract that it is important to highlight here, that funding is not always secure. As a matter of fact, there is evidence that shows that banks with high liquidity risk might restrict access to these liquidity facilities. And this can have detrimental effects on those firms that lose access to these liquidity facilities. For instance, cash-strapped firms might be forced to sell assets in place in order to obtain the required funds. So in this paper, I will provide a normative analysis of credit lines. So how I'm gonna do this? Well, I built up a contract theoretic model of credit lines in which firms might need liquidity to prevent their liquidation, and the liquidation of each firm can contribute to depress the equilibrium liquidation value of other firms in the economy. And there is an aggregate state that will determine the number of firms in need of liquidity. And in order to protect themselves against this liquidity risk, firms can obtain a credit line contract from banks. And in an ex-ante stage, firms and banks will agree on the credit line contractual terms. Banks will choose at the same time pre-arranged funding, and they will use this pre-arranged funding to create cash reserves. And these cash reserves are going to be used to partly finance future drawdowns. But if that is not enough, additional exposed funding can be raised by the bank. However, how much exposed funding the bank can raise will be limited by the bank's revenue. And as a consequence, in some high liquidity need aggregate states, it might happen that the demand for drawdowns cannot be fully met by the bank. And in that case, some firms will not obtain a loan and will be liquidated. And it's in those states in which this pre-arranged funding will become key, as larger amounts of pre-arranged funding can help the bank to sustain lending. But this will be costly, as we will see in the model. Well, this is acknowledged by banks and firms, and they optimally decide on the contractual terms of the credit line. So first, I will solve the optimal private arrangement, and I show that if high liquidity need states are rare, then the optimal credit line will feature partial insurance. And next, I evaluate whether this contract is efficient or not. And I show that under the presence of fire sale externalities, banks choose low levels of pre-arranged funding compared to a constrained social planner. So the private arrangement doesn't provide enough insurance. And next, I show that by requiring banks requirement on minimum pre-arranged funding, constraint efficiency can be restored. And this ratio, this minimum requirement, looks like Basel III liquidity ratios. And finally, I do comparative statistics to show how this requirement changes with the main parameters of the model. So now let me provide more details about the theoretical model in the paper. There are 3 dates, and there are 3 types of risk-neutral agents. On the demand side, we have firms that may require 1 unit of funds to avert their liquidation, and banks will channel funds from investor to firms by means of credit lines. And they finance these credit line drawdowns with pre-arranged funding that is raised at equal 0 to create cash reserves. And if additional funding is needed, then the bank can raise D at T equal 1. Investors will demand a gross return R for funding D, whereas pre-arranged funding will require an extra return. We can understand this extra return as the foregone return that the bank must let go for keeping these funds aside in a liquid form. On the demand side, we have a mass one of identical firms that might need 1 unit of funds. And conditional on the aggregate state, this liquidity shock is IID. And with probability alpha, the firm might need 1 unit of funds, and with probability 1 minus alpha, funds might not be needed. And due to the IID assumption, alpha will coincide with the demand for liquidity of the firms. And before individual uncertainty is revealed, aggregate uncertainty is realized at the beginning of T equal 1. This aggregate state is observable but unverifiable, and specifically, a realization of alpha will be known at T equal 1, and this realization of alpha will come from this PDF, which is known when contracting at T equals 0. And at day 2, production will happen. Those firms that are not liquidated will produce X, whereas those that are liquidated will produce Q. Those that are liquidated are the ones that suffer the liquidity shock and they don't obtain a loan from the bank. And it will be efficient to finance the continuation of the firm, as the continuation return will be higher than the liquidation return. But I will assume that only part of the cash flow of X, a part Y, can be pledged to outsiders. And specifically, Y will be smaller than R, which means that the firm cannot directly borrow from investors. As what they can promise to them might not be enough to appropriately remunerate them. However, by signing a credit line before the liquidity shock is revealed, the firm can promise some payment to the bank in case the credit line is not used, in order to have the right to use the credit line when the liquidity shock hits. Notice that from the lender's perspective, a credit line drawdown has a negative NPV, but due to the fact that the firm can promise something to the bank when the credit line is not used, this allows the firm to use the credit line. So there is a subsidy across the states that allow the firm to use the credit line. So in a way, the credit line works as an insurance contract. And on the supply side, we have a representative bank that offers credit lines at date 0. They have access to 1 unit of funds. If the credit line is used, they pay the firm pays B. If it is not used, it pays fee F. Pre-arranged funding E is raised at day 0 and stored as cash to partly finance future drawdowns. And this pre-arranged funding E is junior to funding D. And I will explain in the next slide why this is important. And the contractual terms of the credit lines will be determined by competition at day 0. So what's the main problem with the contract in this model is that for high realization of alpha, what the bank has to raise might not be enough to fully cover the demand for drawdowns. And as a consequence, some firms will not obtain a loan and will be liquidated. Recall that higher realizations of alpha shrinks the credit line revenue of the bank, making it harder for the bank to fully meet the demand for drawdowns. And it's in those states in which this pre-arranged funding will become key to sustain lending, as the bank can dilute claims on E in order to use the entire credit line revenue and promise this credit revenue to investors in order to borrow as much as possible to meet the demand for drawdowns. However, increasing E will have a higher cost, as we have to recall that pre-arranged funding E requires an extra return. So, to fully characterize the contract, due to competition, the credit line contract can be characterized in the following manner. The representative bank will maximize the expected payoff of the representative firm, subject to the participation constraint of investors who provide E at date 0, and given aggregate liquidations. So in particular, the problem of the representative bank will look like this. And let me highlight two points here. First, there is a first region that goes from 0 to alpha lower bar, in which any credit line drawdown will be fully met by the bank. But there is a second region in which those firms that are in need of liquidity might not obtain a loan from the bank, and as a consequence, the firm will be liquidated. And also, it is in this region in which claims on pre-arranged funding are fully diluted, because the bank is using the entire credit line revenue to lend as much as possible to firms. As a consequence, initial investors receive a zero payoff in this second region, but in order to be appropriately remunerated in expected terms, they receive a promise of a higher payment in the first region when the credit line, when the usage of the credit line is low. So the trade-off behind the choice of pre-arranged funding comes from these two ingredients. On the one hand, increasing it helps to improve the insurance of the contract, but this comes at a cost. So these contractual terms are obtained by equalizing the marginal benefit to the marginal cost of fee. And I show in the paper that as long as these high realizations of alpha are rare, then the optimal credit line contract will feature partial insurance. In particular, it will not be cost efficient to have large cash buffers, large liquidity buffers to fully insure firms in states that are quite unlikely to happen. So the credit line, the optimal credit line can save on this liquidity buffer by allowing partial insurance when the liquidity shock is high. And next, I evaluate whether this contract is efficient or not, and I set up the problem of the social planner that looks quite similar to the problem of the bank in unregulated equilibrium, only that the social planner will take into consideration the effect on aggregate liquidations. And in particular, due to the presence of fire sale externalities, the marginal social benefit will be larger than the marginal private benefit, because the social planner will take into consideration the effect of the contractual terms on liquidations and how these liquidations can, how these lower liquidations can help to save on fire sale losses to everyone. So it will be socially desirable to increase the amount of pre-arranged funding above the level chosen by the bank in unregulated equilibrium. And next, I show in the paper that requiring the bank to hold a minimum of pre-arranged junior funding can help to restore constraint efficiency. And the main result of the paper is the following, that as long as this requirement coincides with the choice of the social planner, then constraint efficiency is restored. This will come at a higher cost because now the liquidity buffers, the amount of pre-arranged funding has to be increased, and because this pre-arranged funding is higher, then the cost of the credit line will also have to increase. But overall, the welfare increases because fewer liquidations will happen in bad times. And finally, in the paper, I provide some regulatory lessons related with, first I do a comparative static analysis to see how this requirement changes with the main parameters of the model. And I also talk about the importance of an appropriate calibration of this minimum liquidity requirement. So let me conclude here by just saying that I provide a theoretical model in which the optimal private arrangement, the credit line in the optimal private arrangement shows partial insurance, which is coherent with what we observe in real life, and also that this is not necessarily bad, but as long as there is these fire sale externalities, then this contract is constrained inefficient, and constrained efficiency can be restored by a minimum liquidity requirement that looks like Basel III liquidity ratios. That will be all from my side. Thank you very much for your attention.
So, Marcus, I think you're next.
So thanks a lot for having me discuss this paper, and thanks to Jose for the nice presentation. So the paper studies the optimal regulation of credit lines, and it's a bit like Holmström Tirol type of simple setting. We have three types of agents. There's firms, banks, and investors. And there's three periods, 0, 1, and 2. Firms have profitable projects, which, however, can require a liquidity injection at the interim period, so T equals 1. These liquidity shocks depend on an aggregate state. And here's the key assumption. So without injections, projects are liquidated at some value Q Z, where Z is the number of firms liquidating. So the price at which a firm is can liquidate the project depends on the amount of total liquidations. So there's a kind of like a pecuniary externality or a fire sale externality in the model. So these atomistic firms don't internalize this effect. The firms can try to avoid these liquidations by setting a credit line with the banks. So that's kind of like the firm side of it. Then we have the banks, and the banks finance their activities using two types of contracts. So first, they can use prearranged junior funding, which I guess you can think of it as equity, and it's also assumed to be more expensive. And then there is ex post funding. Then there's sort of like the bank kind of faces type of like liquidity risk. So without sufficient liquidity, a bank has to terminate the credit line. Junior prearranged funding or kind of like equity lowers this liquidity risk since it can be diluted if there are a lot of liquidation needs. Hence, more junior funding then leads to less terminations and project liquidations. Now, the banks, like the firms, they're also like atomistic, so they don't internalize these effects that the decisions have on this kind of like aggregate prices. So then the less fair equilibrium features too little junior funding, kind of like the banks hold kind of like too little equity. Now, then Jose solves for the kind of like the planner problem to constrain efficient solution. And then he shows that it can be attained by, for example, by setting a minimal level of prearranged funding. And he argues that that solution is akin to the Basel LCR type ratio. I think overall it's a very interesting, well-executed paper. The results are kind of like clean, very neat. I have some comments on how to improve kind of like the policy relevance and clarify some of the assumptions in the model. Okay, so my first comment is I think you could try to a little bit improve the policy relevance. So right now it reads a bit more like providing explanations for current policy. So it's a bit more like kind of like microfounding the kind of like the Basel LCR type ratio. So I think you could think a little bit more like, are there some new policy implications? And I think the place where you could try to do it is you have this kind of like comparative statics exercise. So you show how like the optimal policy depends on these model parameters. But that section I think is a bit underdeveloped. So you could try to kind of push that section a bit further and try to kind of map the discussion in that section to some like more concrete policy suggestions. So right now it's kind of sort of like a bit theoretical perhaps. Also, you could explain more carefully why you think this minimal level of junior funding, kind of like minimal level of equity is a kind of Basel LCR ratio. That's kind of like more like when I think of that, I think of it as more like how much like liquid assets a bank should hold. So it's not like directly about bank equity. Then there is this kind of like equivalence of different type of policies. So a lot of these different kind of like bank ratios kind of like give sort of like the same result. Also implement kind of like the planner solutions. I was thinking like, is that sort of like equivalence between the different ratios? That it's kind of like interesting, but it's realistic. So why do we have all of those like different ratios? So you could think of that a little bit more. My second comment is that you could also better explain some of the assumptions in the model. So for example, a minimal level of such funding, basically like this kind of what he calls junior funding, that's not like directly about regulated credit lines. So it's more like regulating more like the liability side. And so it's not so much about credit lines at least on and the second point is that the Basel type LCR ratio, it could have resulted from other types of models as well. So in this previously we discussed, for example, deposit outflow shocks. So you could kind of like clarify why are the credit lines kind of like so important, why they're kind of like unique for kind of like explaining this kind of like LCR type ratio. So I think you could have like microfunding the LCR type ratio and like many other types of models which don't have kind of like credit lines. So I think you should think of that a bit more. Then my final comment is that the key trade-off here is basically that having more of the pre-arranged funding, having more equity, it lowers these liquidations. But the other side of the trade-off is kind of like just assumed. So it's assumed that it's equity funding or junior pre-arranged funding is more costly. So the trade-off is between these costs of this funding and the like lower liquidity risk. But it's kind of like a risk-neutral model. So we would kind of like expect all of these different types of securities to kind of yield the same return. So I think we kind of like discuss this assumption that the equity here is kind of like more costly in this kind of like risk-neutral model in a bit more detail. But yeah, overall, I think it's a pretty neat paper. So yeah, thanks.
Good. Any questions before giving the floor back to Jose? I think we have one question in the chat, right? Yes. So I think this is a question from Tiago. How would policy implications change when introducing heterogeneity of firms with respect to credit risk and with respect to liquidity shocks? So in terms of having some element of heterogeneity generally introduced in the model. Jose, I don't know whether you want to react to this.
Okay, thank you very much, Marcus, for a very nice discussion. I agree with you. Currently, actually, I'm working more on this comparative statics section. As you already mentioned, this could improve the relevance, the policy relevance of the paper, particularly because right now under Basel, under the capital framework, for instance, of Basel, there is this factor that translates off-balance exposure into on-balance sheet exposures. And this credit conversion factor is basically given at, if not mistaken, 10%. And however, in the paper, I'm discussing that actually these requirements are sensitive to the economic fundamentals of the countries or the jurisdictions that want to apply this type of regulation. So I'm already working on this. And true, there actually the tool that I'm discussing in the paper actually looks more at least to me, it looks more like a requirement on a stable funding source to finance undrawn credit lines. And in this sense, it can be seen better, actually, because what we are saying in the paper is basically that the way undrawn credit lines should be financed with stable funding sources, and in this case, the pre-arranged funding. And also important that you already mentioned is that the importance of why credit lines are important and why credit lines might need a special regulation. And in this case, I think the importance here in the paper is the possibility of the banks to renege, to cancel credit lines by invoking these financial covenants that allows them the possibility of letting firms being more exposed to these high liquidity episodes. But nonetheless, I will work a bit more on this, and thank you for your comments. And regarding the question of Thiago, actually, I will have to think a bit more about this. Right now, I don't have an answer. But thank you very much. I'm taking note.